Imagine, for a second, it's a Tuesday morning in Seattle. FBI agents stormed the headquarters of Amazon. They aren't there for coffee. They're there for blood. Now, imagine Jeff Bezos' middle managers don't just call their lawyers, they start throwing punches. Literal right hooks aimed at federal agents. Sounds like a fever dream? Sounds like the plot of a bad Hollywood thriller? Well, wake up. Because this is exactly what is happening right now in the second largest economy on Earth. And if you hold the S&P 500, if you own Amazon stock, or if you just like buying cheap electronics without bankrupting your checking account, you need to pay attention. The company is PDD Holdings. You know them as the owner of Temu, the app that has likely delivered 5 packages to your neighbor's doorstep this week. As of this morning, January 21, 2026, the Chinese government has officially slapped PDD with a fine. On paper, it looks like a parking ticket. 100,000 yuan. That's about $14,000. For a company worth billions, that's not even a rounding error. It's a tip at a corporate lunch. But don't let the small number fool you. This isn't a fine, it's a target designator. Wall Street is cheering. The stock jumped 7% in Germany because the uncertainty is over. But I'm here to tell you that Wall Street is wrong. The uncertainty isn't over. The war has just begun. We are watching the slow-motion demolition of one of the most aggressive companies in history, and the shrapnel is going to hit your portfolio. Let's peel back the layers. Let's look at the headlines crossing the Bloomberg terminals this morning. Xinhua, the Chinese state mouthpiece, reported that Shanghai tax authorities fined PDD for failing to file essential tax documents for the third quarter of 2025. The penalty? $14,000. If you're a rookie investor, you look at that and say, buy. 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 That's exactly what the algos did this morning on TradeGate. The stock popped 7.6%. The logic seems sound, the government investigated, they found a clerical error, they issued a small fine, and now it's back to business as usual. This is exactly how retail investors get slaughtered. You have to understand the language of Beijing. In the West, a fine is usually the punishment. In China, a small fine like this is often the justification for what comes next. It's the legal precedent that allows the state to open the floodgates. Remember Al Capone? They didn't get him for the murders, the racketeering, or the bootlegging. They got him on tax evasion. That is what we are seeing here. The failure to submit tax-related information on merchants is the smoking gun the regulators needed. It's not about the money. It's about the data. By claiming PDD hid merchant data, the state now has the legal authority to audit every single transaction, every single vendor, and every single dollar that flows through the Temu ecosystem. And here is where it gets dark. This isn't just about missed paperwork. This is the culmination of a violent, and I mean physically violent, struggle for control. Just last month, in December 2025, reports leaked that PDD employees actually exchanged blows with regulators. Fistfights. In the corporate headquarters. When was the last time you heard of Apple employees brawling with the SEC? Following that altercation, Beijing didn't back down. They doubled down. They dispatched over 100 investigators from various agencies to camp out at PDD's Shanghai HQ. This isn't an audit, it's an occupation. So, when you see that stock price jumping today because of a small fine, realize that you are watching a dead cat bounce of epic proportions. The market is pricing in a resolution. I am pricing in an execution. To understand why this matters to your wallet, we have to understand what PDD actually is. 3 years ago, PDD was the scrappy underdog. They were the VC-backed fighter taking on the Goliath that is Alibaba. And they won. For a brief moment, they actually surpassed Alibaba in market value. They did it by being ruthless. They gamified shopping. They squeezed suppliers until they screamed. They subsidized shipping to the US and Europe to undercut Amazon. They built an empire on what we call the C2M model, consumer to manufacturer. They cut out every middleman, connecting a factory in Guangdong directly to a teenager in Liverpool or a housewife in Ohio. But that ruthlessness is a double-edged sword. In November, PDD warned us. They told investors that the golden age was over. They warned of a slowdown as Alibaba and JD.com intensified their counterattacks. But the real threat wasn't the competition, it was the method. Reports indicate that PDD's internal culture is intense 996 work culture on steroids. But the government's probe into fraudulent deliveries and merchant mistreatment suggests something deeper. Think back to the US in the early 20th century. Standard Oil. The Trust Busters. The US government realized that Rockefeller had become more powerful than the state, so they broke him up. Now fast forward to 2026 China. The Communist Party has a very simple rule: nothing can be more powerful than the party. PDD became too big, too fast, and too unruly. When their employees fought back against regulators, they crossed a red line. In the eyes of Beijing, this isn't a company anymore, it's a rogue state operating within their borders. And this is where the common prosperity narrative kicks in again. We saw it with Jack Ma in 2020. We saw it with the education sector in 2021. And now, in 2026, we are seeing it with the cross-border e-commerce giants. The $14,000 fine is the state saying, "We found the crack in your armor." The 100 investigators currently tearing apart the Shanghai office are there to widen that crack until the whole structure collapses. Okay, you say. I don't own Chinese stocks. I learned my lesson with Baba. Why should I care? Here is why you need to care. This isn't just a Chinese story. This is a global inflation and supply chain story. 1. The Amazon factor. If you own the S&P 500, you own Amazon. For the last 3 years, Amazon has been bleeding margin trying to compete with Temu. Temu's strategy was growth at all costs, losing money on every order just to steal market share from Bezos. If Beijing cripples PDD, Temu loses its subsidization machine. They will be forced to raise prices or exit markets. The bull case for Amazon: if Temu fades, Amazon regains pricing power. This is incredibly bullish for Amazon stock in the medium term. The bear case for consumers: competition keeps prices down. If Temu disappears, the price of your cheap goods, chargers, clothes, home goods goes up. That is inflationary. 2. The inflationary ripple. We are already dealing with sticky inflation in the US and UK. One of the few deflationary forces keeping a lid on the CPI has been the flood of cheap Chinese goods via platforms like Temu and Shine. If this regulatory crackdown disrupts PDD's logistics, and we know it already has, with marketing campaigns slowed ahead of the Lunar New Year, we are looking at a supply shock. When the supply of cheap goods drops, prices rise. The Federal Reserve watches this data. If inflation ticks up because the Temu effect vanishes, interest rates stay higher for longer. That hurts your mortgage, your car loan, and your tech stocks. 3. The contagion effect. Look at the broader market. When China sneezes, global equities catch a cold. We are seeing PDD shares jump in Germany, but look at the flows. Smart money is getting out. If PDD collapses or gets nationalized, it triggers a massive repricing of risk for all emerging market assets. If you have a pension fund, a 401k, or an ETF portfolio, check your exposure to emerging markets. You might be holding PDD without even knowing it. And right now, that holding is radioactive. Let's get technical for a moment. I want to explain how this crackdown kills a company, because it's not about sending the CEO to jail. It's about sand in the gears. The report mentions that the scrutiny has slowed marketing campaigns ahead of the Lunar New Year. In the e-commerce world, momentum is everything. It's a flywheel. You spend millions on ads to get users, users buy goods, merchants see volume, merchants lower prices, you get more users. The presence of 100 investigators freezes this flywheel. 1. Management paralysis. Executives aren't planning the next Super Bowl ad, they are sitting in interrogation rooms explaining tax receipts from Q3 2025. 2. Merchant panic. If you are a factory owner in Shenzhen and you hear PDD is under investigation for tax issues regarding merchants, what do? You pull your inventory. You stop selling. You move to TikTok Shop or back to Alibaba. The platform loses its best sellers. 3. Brain drain. Who wants to work for a company where the HR strategy involves fighting the police? The best engineers are updating their resumes right now. This is a death by 1,000 cuts. The $14,000 fine is just the first cut. We saw this with Didi. They had a data security review. It forced them to delist from the New York Stock Exchange. Their stock fell 90%. PDD is following the exact same playbook. The tax rectification is the data security review of 2026. We need to put this in perspective. Many of you are looking at the chart and thinking, it's down 40% from the highs, it's a bargain. In 2008, Bear Stearns stock looked like a bargain when it dropped 50%. Then it dropped another 90%. Then it went to zero. When a company faces an existential regulatory threat, fundamental analysis goes out the window. PE ratios don't matter. Revenue growth doesn't matter. The only thing that matters is political favor. In the US, if the government goes after a company, they fight in court. It takes 10 years. Look at Google versus the DOJ. It's a slow dance. In China, the court is the government. There is no appeal process. When the verdict is handed down, like this fine today, it is absolute. The jump in share price today on TradeGate is reminiscent of the suckers rally in 2000. Tech stocks would bounce 10 to 15% on bad news because investors thought the bottom was in. But the structural damage was done. PDD's structural damage is that its business model relied on flying under the radar. They can no longer do that. Here is the wildcard that nobody is talking about. PDD is the parent company. Temu is the face in the West. We are entering 2026 with heightened tensions between Washington and Beijing. Trade tariffs are back on the table. Data privacy laws are tightening in Europe. For a long time, PDD tried to pretend Temu was a separate entity. They even moved their headquarters to Ireland to distance themselves from China. This tax probe destroys that narrative. By fining PDD for merchant data issues, China is reasserting its sovereignty over the company's entire data pipeline. Beijing is essentially saying, we own your data. All of it. This makes Temu toxic in Washington. If the Chinese government has direct access to PDD's merchant and transaction data, which this investigation ensures they will, then American regulators have every reason to ban Temu on national security grounds, just like they threatened with TikTok. So PDD is getting squeezed from both sides. From the east, Beijing is crushing them for being too unruly and tax avoidant. From the west, Washington is looking at this investigation and seeing proof that PDD is an arm of the CCP surveillance state. This is the worst-case scenario for a stock. It's a geopolitical piñata. So, where do we go from here? As an investor, you need to game out the scenarios. I see 3 paths forward. Scenario 1, the Alibaba path. PDD pays a massive fine, not $14,000, but billions, later this year. They publicly apologize. They restructure. Growth slows down permanently. The stock becomes dead money for a decade. It survives, but it never thrives again. Temu raises prices, and Amazon breathes a sigh of relief. Scenario 2, the Anbang path. This is the nightmare. The investigation uncovers massive fraud specifically related to those fraudulent deliveries mentioned in the report. The state seizes the company. The stock goes to zero. Current shareholders get wiped out. This is what happened to the Anbang Insurance Group. Scenario 3, the miracle recovery. PDD manages to appease the regulators quickly. The $14,000 fine is truly the end of it. They resume marketing. The Lunar New Year sales figures are huge. The stock doubles from here. Why do I give Scenario 3 only 20%? Because of the violence. You don't send 100 investigators and get into fistfights if you plan on letting the company off the hook. The relationship is broken. So, what do you do? If you are holding PDD shares hoping for a bounce, be extremely careful. You are picking up pennies in front of a steamroller. The 7.6% jump today is an exit liquidity event provided by algorithms that don't understand politics. If you are holding US tech, watch this closely. If PDD falls, these US giants gain market share. It is a bullish signal for American e-commerce. If you are a consumer, buy your cheap stuff now. The era of subsidized, ultra-cheap shipping from China is ending. Whether through tariffs or through Beijing's crackdown on PDD, the economics don't work anymore. The $14,000 fine isn't just a headline. It's the sound of a closing door. The era of the Wild West in Chinese tech is officially over. The state has moved in. And in the game of state versus corporation, the state always wins. Don't be the one holding the bag when the real fine drops. Thanks for watching. If you want to know which US logistics companies are poised to profit from Temu's potential collapse, check out my deep dive on the supply chain crisis right here. I'll see you in the next one.